Hello and welcome to IG's Trading the Markets podcast. Now, very quickly before we get started, if you do have any questions, please get in contact with us on Twitter. We're at IGTV. Now, OPEC Plus has extended its record oil production cuts to the end of July over the weekend. The oil cartel decided to roll over its existing 9.7 million barrels per day at its latest meeting. That's helping to extend oil price gains, at least at the start of the week. However, the rally was short-lived after Saudi Arabia's energy minister said the nation plans to end deeper voluntary cuts as the global economy shows signs of recovery. Joining me on the podcast today, I'm pleased to say, is the self-confessed oilaholic, and he's a contributor at Forbes. It's Gaurav Sharma. Gaurav, great to have you back.
It's great to be back and discussing the state of affairs, the crude state of affairs, I should say.
Absolutely. So let's start talking a bit about what happened over the weekend. And we obviously did get those production cuts, but in terms of how it flowed through into the markets, that rally was very short-lived. So is this all about what we heard from Saudi afterwards about its withdrawal of the extra voluntary cuts?
I think above and beyond anything else, what it's first and foremost is about is that the market can see through the OPEC fudge, as I call it. And I think the key thing here is that quite a few of us thought OPEC would indeed roll the cuts over, but the devil is in the details, and they have extended them, rolled them over by a month. Quite a bit of it was priced in, hence we got a little bit of a rally before OPEC, the powers that be at OPEC sat down. And then, of course, there was a clangor on Sunday, the Saudi oil minister saying, well, you know what, we're doing these voluntary cuts about 1.2 million barrels per day, and they won't be happening after June is out of the way. Now, the key thing there is that if you rewind the clock back to the Easter weekend agreement between OPEC Plus, it was sort of as if Saudi Arabia and Russia were actually cutting from a position of strength of about 11 million barrels per day. And that cut was solely predicated on these two oil and gas superpowers cutting about 2.5 million barrels per day from that level. Now, all of this is very confusing for the people who are observing the market, saying, well, where was Saudi production at? Where was Russian production at? And what have the cuts been like? Out of the ether was plucked a figure of 9.7 million barrels per day, which, as you would have observed over the last 4 to 6 weeks, has been found to be, well, the compliance with it has been somewhere in the region of about less than 80%, which is a very poor performance. So they rolled it over, the market got a little bit of a bounce, and then suddenly the Saudi minister says, well, there were some voluntary cuts in there, and we're not going to honor them. And here we are. I think it's very premature to sort of assume that the $40 per barrel level is sort of here to stay and that it's safe. In my opinion, it's not, because right now it's still to be pinned down who is complying, who's not. And we know that the likes of Iraq have been naughty boys.
Yeah, I mean, on the subject of actual prices, from that peak that we had back in January down to the trough in April, we saw Brent crude decline by more than 70% on the IG platform. And we know that since then it has been broadly on the climb, and it's tried to retrace about 50% of those losses that we saw in the first quarter. It has been stumbling a bit this week. I mean, in terms of the moves that you're seeing in 2020, is this one of the most volatile periods you've seen?
Well, absolutely. I think hawk-eyed observers and listeners of this broadcast would acknowledge that if you take it in numeric terms, there's been some sort of an $80 bounce back in terms of West Texas Intermediate. So the US crude fell minus $37 on the 20th of April. And now yet here we are, a plus and over and above a similar level in positive territory. Now, that is a little bit phony, because the negativity went out pretty much the next day when the May contract expired. Now, volatile it is, but in terms of people who are sort of taking a position via spread bet or even in the physical market, what you have now is some sort of a predictability in a very narrow range. So OPEC has done what it needs to do. After July is out of the way, I think OPEC cuts will, I don't know whether they'll sort of roll it over to a similar level. But what we know is that OPEC will keep cutting it. At least the Gulf producer will keep some semblance or some illusion that they're cutting. The key thing here
Okay,
is that the volatility is likely to remain range bound until and unless we know that aviation is back on track, because that is a huge driver for prices. And right now, we still know that a lot of the airlines are nowhere near their pre-COVID-19 levels.
yeah, okay, I want to get a bit more into the demand side in a moment, but just one more question on supply, because obviously OPEC is trying to curb supply. But at the same time, when we look at the latest US crude inventories, we're expecting a drawdown. And in fact, we saw a massive climb of 8.4 million barrels in the week to the 9th of June. That's according to the API data, which was much bigger than anticipated. Does that raise oversupply concerns for you? And what's the knock on impact for storage as well?
I think the storage story was to begin with a little bit overblown, that we'll run out of storage. Satellite data still indicated that there was plenty of storage available, but rather that it was spoken for. Now what is happening is that the market is showing some level of a recovery, but the problem here is that a number of the recovery will start when inventories, as you mentioned, they're quite bloated at the moment. So when we look at price versus supply concerns, no matter how much OPEC cuts, unless demand fires up, these level of cuts will sort of be shrugged off by the market, as we've seen in the last few sessions. So in terms of the balancing the supply demand dynamic, the inventories are likely to remain bloated for the next 2 quarters at the very least. And of course, it also depends on whether consumption improves or not.
Yeah, so on the sort of demand side, you pointed to the fact that airlines is the real pivotal point as to whether there is going to be enough demand to get that market back into balance. What about China, though? Because we know that it's essentially through the worst of the pandemic. I mean, to what extent will the resumption of its own economic activity help to drive a recovery in oil demand?
Well, China has on average, has a very voracious appetite for oil. On average, they import somewhere in the region of 14 million barrels per day. Now, at the height of COVID, that took a severe knock. Empirical data as well as anecdotal data suggests that Chinese consumption is reasonably back on track. Now, what we are likely to see here is that this year the Chinese government itself has said that it will not have any growth targets. Now, in the absence of those, whether you trust them or not is a different matter, but in the absence of those, where the market goes is again a case of shooting blind. Chinese demand is up, but we're nowhere near the heydays of their consumption, the increase in their consumption in the last crisis. So if we talk about increase in China's consumption after the global financial crisis, that was much more predictable than where the market currently finds itself post-COVID, if we dare to use that expression right now.
Okay, let's talk a bit about oil companies and oil stocks, because we saw that BP said it's going to axe 10,000 jobs in response to the coronavirus. I mean, what is likely to be the impact of COVID and the pandemic on the oil sector? Is this a temporary shock, or is this likely to be a prolonged period of pain for the oil sector?
Look, I think it's a cyclical industry. So BP is not the only one that's sort of going through this pain. Chevron has several issues, and it said it's going to reduce its global workforce by around 10 to 15%, with similar levels to BP. Shell has an ongoing voluntary redundancy program. They're all doing it because it's a very cyclical industry. Now, it has taken a severe beating, but I would still say that the impact of the last crisis, the global financial crisis, was much more prolonged. That the recovery took, the downturn started in 2007, the recovery could not meaningfully take hold till the middle of 2010. Now, with COVID, the near-term loss has been very dramatic. It's quite substantial. But there's also the potential, especially around about the first quarter of 21, of a reversal. Now, how do you factor that into your thinking in terms of oil stocks? I think BP still remains a very good long-term buy. And over the near term, if somebody took a position BP, let's say early in March, it was down to almost 230p, and we can see today's levels. So if you took a position then, and then you pull out of the market today, you would have still made a substantial gain at the low point. So these remain bankable long-term stock, but not everyone. There are lots of very troubling companies out there.
Absolutely. I mean, BP may be a good long-term buy in your opinion, but you also wrote an article last month in Forbes highlighting 3 oil companies that you say could go bust as soon as this year. Can you talk to us a bit more about one or more of those companies that you still likely think could go under?
I think the three that I mentioned were Chesapeake, Occidental, and Callum. So we'll start with the last one first. Shale is in a whole host of trouble. Now, let me attach a caveat. I am not implying that shale is dead. There's been quite a bit of that discourse. The Americans will suffer. They'll lose about 1.75 million barrels per day, but shale will remain in the game over the medium term. But the problem of Callum was that it became a sort of a company that is so inward looking, so Texas focused, so shale focused, that it has run into trouble. Chesapeake's troubles are well documented. I think Chesapeake's future is very well in the balance. The company has substantial debts, and that it's trying to rework its debt position, but quite a bit of that debt sort of matures this year, and that puts it in a very difficult position. In fact, we might hear something on Chesapeake over the next 2-3 weeks, if not sooner, as to how they'll get their house in order. And Chapter 11 under US rules seems likely. Now, Occidental is a victim of its own hubris. Basically, the Anadarko acquisition last year was so overpriced. I mean, Victoria spending $50 billion on Anadarko and trying to get into a bidding war with Chevron, where you end up actually compensating Chevron by $1 billion, was an act of extreme foolishness. And Vicky Hollop, the CEO, and Occidental might have gotten away with it, but then COVID happened, and now we see Occidental scrambling to divest, cutting its dividend. I mean, what is this? Cutting the dividend by 90%? You may as well remove it totally. And this is a company that is clutching at the straws. Who knows what the positioning is regarding their agreement with Warren Buffett and his position in Occidental? But I would not rule it out that Occidental itself goes down the Chapter 11 route, because right now it's scrambling to service its debts, and those debts are somewhere in the region of $35 billion.
All right, Gaurav, thank you so much for your time. As always, sadly, that's all we have time for today. Thank you to my guest, Gaurav Sharma, the self-confessed oilaholic and contributor at Forbes. I'm Victoria Scholar, and thank you so much for listening to IG's Trading the Markets podcast. And don't forget to subscribe.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.